Welcome to SNB Experts Learning Platform. I am so glad to have you back for this critical session. Today, we begin our deep dive into Module 7, covering derivatives and alternative investments. We will explore how these instruments are structured and why they are vital for modern portfolio management. This module is comprehensive. We start with the definition of a derivative as a contract whose value comes from an underlying asset, like a stock or bond. We will cover the mechanics of futures, forwards, options, and swaps. Then we transition to alternative assets, including real estate, commodities, and crypto. We will examine how these tools are used for hedging to reduce risk, for speculation to leverage bets, and for arbitrage to exploit price inefficiencies in the global markets. These concepts are foundational for advanced financial analysis and must be mastered to navigate today's complex financial landscape effectively. Let's focus on hedging. It is the primary reason derivatives exist in the corporate world. By taking an offsetting position, companies can neutralize risks such as volatile fuel prices or fluctuating exchange rates, ensuring stable cash flows regardless of market conditions. This stability is crucial for long-term planning. We distinguish between futures and forwards. Futures are standardized contracts traded on centralized exchanges like the CME. They offer high liquidity and are marked to market daily, which reduces counterparty risk. In contrast, forwards are customized, private agreements between two parties. While forwards offer flexibility to tailor terms to specific needs, they carry significantly higher counterparty risk since there is no central clearinghouse to guarantee the trade. Choosing between them depends on your specific needs for customization versus security, as well as your ability to manage the associated margin requirements and clearing obligations. Pricing these instruments relies on the cost of carry model. The fair price of a future is the spot price adjusted for the risk-free interest rate and the time to maturity. This ensures that the price reflects the opportunity cost of holding the underlying asset versus the cash. Deviations from this price create arbitrage opportunities. Consider an airline facing rising jet fuel costs. They can buy crude oil futures to lock in a price. If oil rallies, the profit on the futures offsets the higher fuel bill. Conversely, a coffee farmer fears falling prices at harvest. By selling futures contracts now, they lock in their revenue. If prices drop, the futures gain compensates for the lower crop value. Similarly, a portfolio manager fearing a market crash can short S&P 500 futures to protect the value of their equity holdings. These examples illustrate how derivatives act as essential insurance policies for real economy businesses, protecting them from market volatility they cannot control. For exporters, currency risk is a major threat. A Rwandan exporter expecting payment in US dollars can sell a USD forward contract. This locks in the exchange rate today, completely eliminating the uncertainty of future currency fluctuations and securing their profit margin in local terms. This allows them to focus on their core business rather than FX speculation. Options offer rights without obligations. A call gives the right to buy, a put gives the right to sell. To master this, we have included an option payoff simulation activity. You will draw payoff diagrams for a stock trading at $60. Calculating profits and break-even points for both buyers and sellers. This exercise is crucial for visualizing the asymmetric risk-reward profile that makes options so unique compared to linear instruments like futures. You will see exactly where you make money and where you lose it, helping you grasp the concept of intrinsic versus extrinsic value in option pricing. The payoff diagram is your roadmap. For a buyer, it shows limited risk, just the premium paid, and potentially unlimited upside. For a seller, the reverse is true, limited gain and potentially unlimited risk. Understanding this asymmetry is fundamental to safe options trading and strategic planning. We use strategies to tailor risk. A covered call involves selling a call against stock you own to generate income in a flat market. A protective put acts as insurance against a crash. More advanced traders use spreads, like the bull call spread, where you buy one call and sell another at a higher strike. This lowers the cost of the trade but caps the potential profit, offering a defined risk-reward ratio suitable for moderate market views. Each strategy serves a specific market outlook and risk tolerance, allowing you to fine-tune your exposure based on your specific forecast for volatility and price direction. When you expect a big move but don't know the direction, you use a straddle, buying both a call and a put. If the market explodes up or crashes down, you profit. This is a pure volatility play, often used around earnings announcements or major economic data releases when uncertainty is highest. Option prices are sensitive to several factors, measured by the Greeks. Delta tracks the underlying price, while theta measures time decay. As we move to swaps, we enter the world of exchanging cash flows. An interest rate swap allows a company to exchange a variable interest payment for a fixed one, stabilizing their debt costs. These are massive over-the-counter contracts used extensively by banks and corporations to manage long-term financial liabilities and interest rate exposure. Understanding these instruments is key to grasping how modern credit markets function at an institutional level. Imagine a company with a floating rate loan that fears rising interest rates. By entering a swap, they effectively convert that loan to a fixed rate. This certainty allows for better long-term budget planning and protects the company's bottom line from monetary policy shifts. It's a classic risk management tool. Derivatives are powerful but dangerous. Leverage risk means a small movement can wipe out your capital. Liquidity risk means you might not be able to exit a trade. We've seen catastrophic failures. Barings Bank collapsed due to unauthorized futures bets. Long-term capital management failed due to extreme leverage, and the 2008 crisis was amplified by credit default swaps. These history lessons teach us that rigorous risk management is non-negotiable when dealing with these complex instruments. You must respect the leverage and understand the counterparty risks inherent in every trade. This brings us to alternative investments. Unlike stocks and bonds, assets like real estate, commodities, and private equity often move independently of the stock market. Adding them to a portfolio provides diversification, reducing overall volatility and improving long-term risk-adjusted returns. They are the stabilizers in a turbulent market. In real estate, we focus on net operating income and cap rates to value properties. We have a practical case study for you, analyzing a commercial property in Kigali. You will calculate the NOI, determine the cap rate, and project a 10-year discounted cash flow. This exercise will help you understand the difference between direct property ownership and investing in liquid real estate investment trusts, or REITs. You'll see how leverage impacts your cash-on-cash returns and how property appreciation contributes to the overall internal rate of return. REITs democratize real estate access. Equity. REITs own properties and collect rent, while mortgage REITs finance them. Because they must distribute 90% of their taxable income, they are a favorite for income-focused investors who want real estate exposure without the headaches of property management or large capital requirements. Commodities like oil and gold are distinct asset classes driven by supply and demand, often serving as effective inflation hedges. Hedge funds, on the other hand, are pooled investment vehicles that aim for absolute returns. They employ complex strategies like global macro and statistical arbitrage. However, investors must be wary of high fees, typically 2 and 20, and lockup periods that restrict liquidity compared to traditional mutual funds. Due diligence is critical here, as the performance gap between the best and worst hedge funds is massive. Private equity offers access to non-public companies. Whether it is venture capital for startups or leveraged buyouts for mature firms, the goal is long-term value creation. Investors must be patient, as the J-curve effect means returns are often negative in the early years before exiting for a profit. It is a game of patience and operational improvement. Cryptocurrency is the newest contender. Bitcoin and Ethereum offer decentralized 24/7 markets and high growth potential, but come with extreme volatility and regulatory risks. When comparing all these alternatives, you must use a framework that evaluates expected return, risk, liquidity, and minimum investment. For instance, while crypto is highly liquid, private equity is not. Real estate offers income, while commodities do not. Balancing these factors is key to building a resilient portfolio that can withstand various economic conditions. To integrate these assets, we look to the Yale endowment model. It shifts away from the traditional 60-40 equity-bond split allocating significantly to illiquid alternatives. This approach captures the illiquidity premium and provides superior long-term diversification and return potential. It has become the gold standard for institutional investing. Constructing a modern portfolio requires balancing these assets. A diversified approach might include 15% real estate and 10% commodities alongside traditional assets. Crucially, all of this operates under a strict regulatory framework. Laws like Dodd-Frank in the US and EMIR in Europe mandate transparency and reduce systemic risk. Staying compliant with these rules is as important as the investment strategy itself. Ignorance of regulation is a major risk factor, so keeping abreast of changes in the legal landscape is part of your fiduciary duty. We have covered an immense amount of ground, from the mathematical precision of option pricing to the strategic broadness of alternative asset allocation. Now, it is time to consolidate this knowledge. Reviewing the key concepts and testing yourself is the best way to ensure retention. Let's wrap up with a final review. Take a moment to look at the Module 7 quiz. Can you calculate the P&L for a call option? Do you know the difference between a future and a forward? Reviewing these questions will highlight any gaps in your understanding. We've journeyed through derivatives mechanics, hedging strategies, and the entire landscape of alternative investments. Use the summary checklist to verify you have mastered each section before moving on. Your understanding here is vital for the next module. Thank you for following this course on behalf of SNB experts. I hope you found this deep dive into Module 7 valuable. Please subscribe to our SNB Experts YouTube channel for more modules and finance insights. Goodbye, and see you next time.